He's going to retire in 20 years. That's a pretty long time horizon. I would think that should all be in the stock market, and most of it should be pretty aggressive. And really, daughter's education in 15 years, we can scare people in our trick questions just like they do at the testing center. Yeah, it's your daughter. Yes, it's education. Yes, it's important. But a lot of people might say, oh, he better be in treasuries. Well, then she's not going to go to school. He's going to be almost entirely in the stock market, growth funds. So a statement of cash flow, it's pretty much like an income statement for a business, but for an individual, we usually call it cash flow. And if this individual were trying to get a mortgage, they'd have to provide something like this. They also usually give bank statements for the previous 2 months so that the lender can see how much money comes in and out in a typical month. But here we can see that salary and investment income, I don't know what the other income is. We could ask, but we have $8,500 in monthly income, but then obviously we have all these expenses, which total $7,000. And then this is either disposable or discretionary income, and this is the only amount that they could possibly be expected to invest. For a balance sheet, the pluses and the minuses, as we saw with Microsoft. And in the video, we look at Starbucks. So everything that has value, like our personal residence, automobiles, obviously these could be losing value quickly. Personal possessions, I have a 1965 Gibson SG, stocks and bonds, okay. Keogh plan, some people still have those. Your IRA, and that's a pretty likely test question. On which financial statement would an individual investor list her IRA on the balance sheet? It's not money in and out. It says, what's the account value? Checking, savings, money market, total assets of 660. Oh, I'm sorry. Okay, and then on the other side, yeah, the house is worth 400, but we still owe 250. At least we have some equity. Still owe on auto loans. Some of you might have student loans, credit card balances. So when you take your assets minus your total liabilities, in this case, the net worth is 385, which is probably not enough to retire on. A lot of people are probably looking for a minimum of $1 million in net worth before they retire. So they can put some percentage in bonds, live off the income there, back off on the stock market investments, but still have some in the stock market to keep up with inflation. But 385 net worth, probably not enough. Depends though. Never know. I have this annuity. I have this defined benefit pension that pays me $170,000 a year. So yeah, I think with this, I'll take out about 5% a year, and that'll be enough. All right, so customer goes online, opens up anything, an IRA, a taxable account, wouldn't matter. They would have to answer some questions about suitability. What is your primary investment objective? And this is as safe as it gets. This is money that I will not put at risk. It's just a little bit riskier than a savings account because it has a fluctuating value, but we're usually talking about treasuries. Income, bonds and preferred stocks. Growth and income, that would often be blue chip stocks that are like Starbucks. They're still in a growth pattern, but they're already starting to pay out dividends. And then for a lot of people, it's just pure growth. I'm in Snapchat, obviously a dividend, I can't imagine that coming for 10 years, but between now when I buy it and 3 or 5 years down the road, this thing might double or triple or go to zero. Growth investors, you're swinging for the fence and you will have some strikeouts. Time horizon, if it's only 6 months, we're not going to put somebody in the stock market. We're not even going to do that over 3 years unless it's a small percentage. We're asking 7+ years for things like a small cap growth fund. Could be volatile, but if you're in here for the long haul, growth funds tend to do a lot better than bond funds or any other fixed income product. But again, if it's only 6 months, we're talking about money market securities, 3 years, maybe treasury notes, same thing for 3 to 6 years, treasury notes. Or short-term bond funds, maybe corporate because they would pay a higher yield. But you still never pick a bond that matures outside of the time horizon. If it's a 3 to 6 year time horizon, we don't buy 10-year bonds. Because when you go to sell them, you might take a loss, and that's a pretty sloppy way to play fixed income investing. You don't really need to be taking big losses on fixed income ever. What percentage of assets outside of your personal residence does this represent? If it's more than 75, we got to be pretty careful. And we always want to be pretty careful. But if it's under 25%, we might be able to be a little bit more aggressive because you're not likely to have to pull money out. And this isn't representing everything you have to invest. So for this, maybe we'll go into international, global investing, even emerging markets. Maybe not just now. And then what are your emergency savings? None? Maybe we need to put X amount into a short-term bond fund so that you could make a withdrawal in an emergency without having to sell when the investment's down 35%, the way a stock market or a real estate investment trust, which is in the stock market, could be. If you got more than 6 months of emergency savings, then it's not likely you'll ever need to come into this account and sell. And then your personal experience. How do you feel about investing? Have you invested in stocks before? Yes, but I was uneasy about it. I might just stay away from stocks then. No, but I look forward to it. Okay, I don't want to scare the heck out of this person. I don't want to buy the super risky stuff. Yes, and I was comfortable with it. Okay, I don't have to explain the fact that he may be up or down 20%, any given month. Whereas fixed income investors aren't usually going to sit still for that. They can phrase number 6 many different ways, but they're trying to see how much you're willing to kind of go double or nothing. I don't know that you would ever know the probability, but if you did, if we told you you had an equal chance of doubling this investment or losing it, how much would you risk? Some people would say none, and some people might risk up to half. So aggressive answers would look like this. They might not all line up this way, but if growth is your objective, that's an aggressive profile. We wouldn't want to go there unless you had at least 7 years. Some firms might say 10. This does not represent a large percentage of what you have to invest in the market. You do have emergency savings. You've done this and you're comfortable with it. And you would risk 50% if you knew that you were basically just as likely to double your money or lose it all. He's going to retire in 20 years. That's a pretty long time horizon. I would think that should all be in the stock market, and most of it should be pretty aggressive. And really, daughter's education in 15 years, we can scare people in our trick questions, just like they do at the testing center. Yeah, it's your daughter. Yes, it's education. Yes, it's important. But a lot of people might say, well, he better be in treasuries. Well, then she's not going to go to school. He's going to be almost entirely in the stock market, growth funds. Because it's 15 years, and you got to not just keep up with inflation, but you got to build up a nest egg, especially when these colleges are $40,000, $60,000 a year. To supplement a teacher's pension, well, she's already got the fixed income piece. We'll probably put her in a conservative stock market investment so that she keeps up with inflation. Here we need income, right? We got to supplement the income you're going to lose when you back off working at your dental or medical practice. And then here, obviously, we've got to be extremely safe. She obviously is no longer working, and we got to make sure that we don't take on any great risk to earn that $300 in monthly income. All of this stuff's important too. But what's the first thing? So you have to do it more like a brain teaser, a puzzle. Well, if I say this, I'm saying that that's more important. Why would I say tax situation first? Because we tried to make you do that. And it's a darn good answer. In my mind, I studied. And the first thing that pops to mind really is tax shelter. That's okay. But now you're talking to an investor. What do direct participation programs all have in common? They all provide tax shelter. No, they don't. What about a raw land program? There's no tax advantage at all. You own a bunch of raw land. You can't depreciate it. There's no natural resource aspect, so you have no depletion. So raw land has no tax advantage, which doesn't mean you wouldn't, get around to it with most of them. But we're saying, okay, all things being equal, they are kind of risky, but are they any riskier than commodities? Probably not, or options, or certain small cap stocks on the bulletin board. I mean, yeah, but not the first thing. Anticipated retirement age, that would probably have to come up, at least for a lot of investors, especially if you're already 58. Like, they're going to want you to invest in this for like 10 years. If you're going to retire at 62, we need to factor that in. It still might make sense, because, well, oh, look at your IRA. Yeah, you're fine. But what do they all have in common? They're illiquid. So that's why this is a little frustrating. You want to just kind of read the section on DPPs and then have them ask you, what's that called? That's the general partner. That's the limited partner. But then they make it kind of snarky. What's the main reason that business owners would form a general partnership? And then they'll say something like, because of the unlimited liability. Like, well, I did learn that there is unlimited liability. Right, but now we're saying, is that why they would do it? No, that's actually not an advantage. Right. Keep shopping. I would say that this is a very sophisticated question because, in fact, you got to talk probably about all of these, because most of them do offer tax shelter, but many is not all. And then a lot of them are risky, but not as a blanket statement. I mean, really, the risk is the lack of liquidity again. The lack of liquidity is risk, in a sense.